Hello, everyone. Welcome to the weekly roundup. Today we will cover inflation, interest rates, and earnings releases. Hello, Ben.
Hey, Eva.
It's officially sweater season.
It really is. I
Yeah.
see lots of cold weather ahead. My girls are practicing soccer outside tonight, though.
Oh no.
Yeah,
Why?
pre-turf, I
They're
guess.
heroes. It's so cold. It's
Yes.
so cold.
Yeah,
Yeah, we have a long one
yeah,
ahead.
we do.
Okay, we have lots to cover today.
Yep.
We're starting off with inflation numbers. This has continued to fall globally. Is this a temporary trend or the start of a permanent structural shift?
I think maybe potentially we're going back to what we saw pre-COVID. We
Okay.
we were in a structural downtrend at that point. Then COVID really disrupted things globally. Yeah, I mean, you could argue that it maybe started to happen before then, but we're definitely heading towards we'll say disinflation or deflation. So I would think that we probably continue to see that. We've unless there's a big reacceleration in costs short term. Some of the CPI numbers that we're going to see over the next couple of months are pretty high last year. So when you start to roll through those monthly
Yeah.
or year-over-year numbers, I think we'll continue to see them contract at this point.
Okay. So with the US government reopened and key data like inflation and jobs reports are now back online,
Yeah.
how could these numbers influence the Fed's upcoming meeting and, their interest rates decisions?
So I think it's made it more challenging for them for sure, because the data came out today and said the jobs numbers was a little bit better, which is not really what they wanted, because they do want rates to come down. So I think that's confused their decisions. And, as most jobs numbers are, I'd say 99% of them, that is, they get revised. So just like every jobs number, the next month they revise them. So I'd expect we probably get a revision lower when we see the data next month, to this number. So I think it's made their decision a little bit more difficult. We're probably at a coin toss right now, but we still have lots of data to catch up on. And their next meeting is December 10th. So we got lots of time between now and then before they have to make a decision. But obviously, this is, I don't think, ideally what they wanted to see. And if you caught any of President Trump yesterday in the White House speaking, he said basically that Chair Powell doesn't know what he's doing. He needs to cut rates, and if he doesn't cut rates, then he's going to fire the Secretary Treasury, Besant, because it's his fault. So I'd say generally the direction is lower, and that's underpriced right now. But short term, there's some data that needs to come out to help them make a decision on cutting.
Okay. So I'm going to digress a bit with a hypothetical question worth exploring. So if the US dollar were to lose its status as the world's reserve currency, what impact could this have on global asset prices?
That's a very difficult question.
I saw
But
it somewhere and I thought it was worth exploring.
yeah, yeah. I mean, it is worth exploring. I think it's important to think about it. When I first started thinking about this, probably in the around 2014, 2015, when I was working with HSBC, and they put out a piece on what's going on with the US dollar and what it looks like in the future with a different reserve currency. And so I think question one really is what happens if it's replaced and what replaces it. So my view since then really has been it's been a basket currency replaces it. And the IMF does their SDR, which is a basket of currencies. That's their reserve strategy. And so that is US dollar, I think something like 40% US dollar, sterling, euro, renminbi, which is the Chinese currency, and I'm blanking on the fifth one. But they have a basket that they settle to. And so I I've thought about it from a multitude of perspectives, but I think the first one is right now, we'll say 85% of world trade's done in US dollars. And if you use SDR at 44%, if you get a 50% reduction in the use of the US dollar, you probably see a pretty material fall in US dollar short term. Long-term ramifications, I think that's a more difficult and maybe a longer conversation to have. But I think immediately what would happen is US dollar gets devalued, but likely on the back of that is asset prices skyrocket temporarily. Right. So there's this, we're afraid our dollar currency is getting devalued. So you get a run up in asset prices. If you're in the US and you have US dollars, then that's an immediate negative. But you get a quick rip up higher in asset prices as the currency devalues. And that probably happens globally because, if all these emerging markets can all of a sudden now get rid of their US dollars or reduce some of that exposure at a devalued currency, that probably makes their currencies go up more and also their assets go up more. So, I mean, it would put the financial world in a bit of a tailspin chaos, but it may help. One of the big issues that the US has is their debt levels. And so if their currency gets cut in half, their debt levels effectively get cut in half as well. So yeah, it's an interesting, I think, important thing to think about, certainly for us and as we guide people in making investment decisions. But I'm still leaning towards what and how's that going to look. I think it's in a basket, and blockchain makes that a lot easier to settle basket currencies globally. So I think we're getting there.
Okay, let's come back to the present.
Yeah.
So, major tech companies reported earnings this week. Were there any surprises? Anything investors should be paying attention to?
I think it's good to look at what's going on. Google came out and Nvidia came out as well last night. So there's a lot of worry slash comparisons to 2000, and I'm quite familiar with 2000 because that's when I started, so I remember what that was like. And I'd say there's some nuances within that. This is another tech-led rally, but in 2000, those companies were just ideas. They didn't generate any revenue. They had hopeful projects in the future. This kind of rally's been a little bit different because NVIDIA, for example, they come out, they show they beat expectations, they profit, they're making money. So a lot of these technology companies are making money. And so I think it's important to keep looking at it. NVIDIA's numbers were good. Market tried to get excited. We are up around 2% on the Nasdaq at the open. Now we're back down to the negative side of things here. I think that has more to do with liquidity than anything. But I think important to still look at what's going on. I think all the big techs have different things that are important to look at. NVIDIA is obviously because of what they do, it's all semiconductor related, and so they're growing, and that's good. Google is trying to diversify away a little bit from advertising because that's where they make so much of their money. Meta as well is tipping away in other directions, looking to generate revenue. So I think it's worth looking at. We've talked about the power needed for all of this future AI that needs to happen. So I think that's more interesting because there's been some power companies that have stumbled a little bit here. So that's investment opportunities. And I think that one's a little bit easier to play from perspective is that's a good infrastructure story. All the governments of the world want infrastructure and power, and it falls in line with how the techs have done.
Okay, sounds good. That's the charts.
Um, you see that okay?
Yep.
Okay. Okay. Think the setup's a little bit different today, but we'll go through it. As always, we're recording this on November 20th at around 1 o'clock. So anything that happens between now and next Friday, which would be the day after Thanksgiving in the US, which will be quite a week next week, but we'll talk about that after. So lots of things to cover. So I wrote about sentiment a bit this week, and I think it's really important, and it's something that I continue to follow and track, and I think is relevant to what we do on a daily basis. Is there's this feeling, I think, that valuations are stretched, and it's true. If you look at the metrics, the valuation numbers are a bit stretched. But there's a couple other things that you need to think about, which is money supply, which we've talked about, and sentiment, I think, which is very key to what happens to the direction of the market. And so this is our internal view around sentiment. And if you look here, we've been hovering around these levels, around 45. And, market tends to act in chaotic ways only when we reach certain levels, which is extreme pessimism or extreme optimism. And we're nowhere close to those barriers right now. If we look at the CNN greed and fear index as well, we're down around 10, 12 on the fear level. So we're getting a little bit more fearful on that side of things. Our index tracks a few more metrics than they do. But if you look back historically here, this is from 2018 when they started using the tracking mechanism. If you look at when we dipped around this level, which is where we are today, around the 45 levels, and then you match it up to the other periods where we saw markets start to accelerate. Once we got down to the lower levels around 45 and below, you tend to get to the market consolidating around 45. If you dip from here further, obviously market would need to fall for that to happen. You likely again get a reacceleration higher, and that does line up a lot with our view where we think money supply comes back and markets start to reaccelerate. But right now we're kind of this neutral treading water period. I think a lot of that has to do with the US shutdown, and we'll see what happens from here. So I like to put this up once or twice a year, at least, anyways, just to think about bond yields. And I try to figure out the best way to explain this. But I think it's a good to look at why you own bonds in portfolios. And there's a number of things to look at. But if we look across the middle of this bar here, this is effectively where interest rates are today. So US 10-year, US 30-year, Canada 10-year, Canada Broad Index, and then the corporate bond universe. And so you're looking at from a simplistic perspective, if you bought the corporate bond index today, you guarantee yourself 3.9% until we'll say maturity of that index, hypothetically. And then if interest rates go up or down in this space, so if we get a 1% move higher in interest rates, so interest rates go up 1%, you'd lose about 1.6% of your money if you had invested there. If interest rates fall 1% from here, you actually make 9.4%. So that's a pretty material move for a conservative investment. And then if you're looking over here to the US 10-year bond, which a lot of people use this as a tracking mechanism for what happens to the health of the economy. So they're sitting at 4.1%. If that number goes to 3.1%, your investment actually goes up 12% in that backdrop. If the opposite happens and we go from 4.1 to 5.1, you lose some of the value of your bond. So this is why it's been good to have bonds in portfolios. You can hold them for because you want the coupon and you want them to mature at face value, or you can hold them for a different perspective, which is what we typically hold for, which is to provide some stability into your portfolios. We know we can get about 4%, and that gives us a buffer. Rates fall, we go up, and if the stocks fall in that backdrop, we're balancing out what's happening in portfolios. So I think it's a great chart just to think about what happens when interest rates move. And if you really, really want to go out and add some, we'll say some protection on the longer end, if you put a small amount of money into long bonds, if we get an equity market correction, long bonds probably come down in that backdrop, and that gives you that ballast you need to reduce risk in portfolios. Canada gold stocks near record weight. So as we've been talking about gold stocks now for quite some time, we've commented on it for a couple of years, but the last 6 months, because there's been such a material rally, we started to touch and talk on it a bit more. So if we look at this since 1975 to now, we've reached a new high. So obviously, if you're a long-term technical individual, then you'd say, are we hitting higher highs? Doesn't look like yet. But if we are hitting higher highs, that's probably a positive. That momentum continues to be there for the gold stocks. But if you are thinking that we're peaking here now as well, you got to think about what you want to do. As you know, reduce risk about a month ago now in gold and gold miners. And so I continue to look and assess and see if this makes sense. Do we keep it? Do we hold? What do we do at this point? But when we start to hit extreme levels like this, it starts to make me look at it and say, I think we need to be conscious of what we do from this point. So this is National Bank's financial forecast, and everybody likes to look at this. So these are targets based on what they think is likely to be the level of where we are in both the S&P 500 and the TSX by year end. So effectively, if we look at these levels, if we look at where we are, so this was in September, so if you're looking at where their target is expected, we're looking at 30,000 roughly, plus or minus where we are today. And if you look at the US side, looks like lower valuations. We're actually lower. We're pretty close to that right now, 65.73 on the S&P. And this is really based on the assumptions of future earnings, so price earnings multiples. And so, as I mentioned off the top here, we're looking at trailing price earnings at 25, and that's an extended multiple. So if you use that as your gauge for where the future target's going to be in the S&P, then that's how you get to these levels. And in the Canadian side here, looking at trailing PE, 18.6 times trailing. So that price earnings multiple as well. I think it's reasonable to look at it just from a perspective of, does this make sense? Do you care about this? But this is based on fundamentals, less to do with some of the other things we talk about. But good to put it out there. Think about these key levels and what do you do at this point? Trim equities, buy bonds, potentially some of those things that you want to think about. As always, the opinions expressed do not necessarily reflect those of National Bank Financial. I've prepared this with research and information that I look at. Everyone's risk tolerance is different. If you have any questions at any time, please feel free to either call myself, Eva, or your advisor, and we're happy to offer some more comments and context around if any of these things are relevant to you. Oh, you're muted.
Okay, there it is.
Yeah, perfect.
What's on the agenda for next week?
Yeah, so I think next week is, as I mentioned on briefly, it's likely a little quieter week because we have Thanksgiving on Thursday. So U.S. markets closed on Thursday, and like most Thanksgivings, likely by 12 o'clock on Wednesday, all of the traders will be on vacation. So I'd anticipate a pretty quiet week, Wednesday, Thursday, Friday. Obviously, we've had past events where we've had some shocking market events that happen in holidays. It's rare, but it does happen. But so I'd anticipate a pretty quiet week. As for data to come out, pretty heavy early in the week in the US, Canada, not too much. So I would say generally lighter volumes, less noise next week. And then that puts us squarely into December. And then we would be looking at what happens there. Probably some tax loss selling cleanup. We saw some of that this week. The telcos were hitting new 52-week lows in Canada, BC, TELUS. So I'd be looking at what's happening there. As I look at stocks hitting new lows, you're getting lots of tax loss selling, but as I do every year, sometimes this presents you really good opportunities because as companies have had a challenging year, people are just dumping them. Doesn't mean they're bad businesses. They're just getting chucked out so you can reduce your overall taxes. So I find this is one of the best times to scramble through the rubble and look for the good companies. And so I'd say as we get into December, I'd look further in detail to see what those names look like and see if we can take advantage of it.
Okay, good. Thank you. Thank you, everyone. Remember to visit, subscribe, and follow us on YouTube and LinkedIn at Hart Investment Group. The link to our daily financial heartbeats will be in the caption of this video and in your email box. For our clients, please reach out to me if you have questions or if you'd like to book a review meeting with Ben. Thank you for listening. Bye.
Take care. Thanks. Bye.